Good afternoon, everyone. My name is Duncan Lamb, and on behalf of Colliers International, I'd like to welcome you to this UK retail market update. We're doing things slightly different this year. I should say welcome back to certain members of you of the call, because you were on the June call that we did, and we're reconvening today with a panel of both Colliers experts and guests from across the industry. In a moment, I'm going to hand over to Dr. Walter Boettcher, who is going to take us through the macroeconomic factors which he feels will impact UK retailing in the short and longer term. And then after that, I'm going to be talking to some of our guests about their perspectives from their respective parts of the sector. And then we'll have a chance for a wider discussion towards the end of the webinar. Because we've got so many people on the call today, it's not possible, I'm afraid, to take questions from the floor, but I'm happy to say that very many of you took advantage of the submit a question facility in the registration, and we've kind of grouped those together into the strongest themes, and we'll go through those in the discussion section at the end. But first, I shall now hand over to Walter Boettcher for his macroeconomic overview. Walter.
Good afternoon. Well, today I promise to keep it short and to the point. It's all about consumer confidence, or perhaps recovery of consumer confidence, because the UK economy relies on consumers more than many other advanced economies. There is a recovery in formation. Is it a V-shaped recovery? Well, it depends how you look at it. In monthly growth terms, the initial recovery has come and gone, as the V1 line in red on the chart aptly shows. However, the V2 line on the chart shows that the economy is still 8.5% smaller than it was at the end of 2019. This reduced activity amounts to around £185 billion shortfall against an economy that should be £2.2 trillion in size. The shortfall means the economy will support fewer jobs. Forecast suggests it'll probably take until the end of 2022 to make up this difference. Consumer spending is the mainstay of the UK economy. It accounts for almost 2/3 of the UK economy. Retail, leisure, and hospitality sectors together account for over half of all consumer spending, or around $650 billion in 2019. Oxford economics forecasts tell us that by the end of 2020, turnover in these sectors will have fallen by around $150 billion to $500 billion. Retail shops, instead of increasing sales by around $7 billion in 2020, will have lost around $30 billion. Internet businesses, instead of increasing sales by around $8 billion, will have increased them by around $30 billion. Leisure and hospitality will have lost, possibly irretrievably, £130 billion. These are big numbers and show why government has supported the economy through furloughing, tax payment deferrals, loans, eviction bans. But an important question is this support sustainable? Well, first, the good news. Despite a phenomenal increase in government spending and borrowing to support the economy, the level of debt is sustainable for now. Net debt may have increased from 1.8 trillion to 2.1 trillion, or around 101% of GDP, but annual interest payments to support the debt have fallen from a 12-month total of 49 billion in October 2019 to a 12-month total of 38 billion in September 2020. That's 11 billion pounds less in debt servicing costs. Why? Well, because interest rates are at near record lows. The UK 10-year gilt is trading at around 0.3%. In fact, the IMF is actively encouraging governments globally to borrow and spend to support economic recoveries to take advantage of these low interest rates. The bad news? Well, someone will eventually have to pay for it, but maybe that's a story for another day. Although I'll tell you that the Chancellor suggested earlier today that this was a medium-term concern, suggesting that the government will remain supportive until the economy has stabilized. Despite government support, a sustained recovery requires sustained recovery in consumer spending. This requires a recovery in consumer confidence. The latest GfK Consumer Confidence Survey in blue shows that the UK consumer confidence is almost as low as it was during the global financial crisis. The orange line shows that consumer confidence in the economic situation was at a record low in July and fell again in October as the COVID numbers increased again. November figures are little changed despite positive news about a vaccine in the middle of the month. Let's see what December brings. The GfK survey also suggests that consumers may not only be hoarding toilet paper, but also cash. I know I am. There's no place to spend it. Everything's closed, although my wife did buy some jewelry to commemorate the first lockdown. But the propensity of households to save, though, has been rising since the vote to leave the EU in 2016 and has remained elevated during most of the pandemic. But what does the official data tell us? The official data confirms the survey findings. Household disposable income may have fallen in Q2, but the household saving ratio is up from a normal 9% of disposable income in Q1 to a record-shattering 28% in Q2. This amounts to 100 billion in savings in Q2 alone. Given a normal savings rate, you'd expect around 30 billion in savings. This suggests there is a 70 billion amount in excess savings. I can promise you it was not interest rates that attracted the savings, but rather fear of economic unknowns. Given that the savings ratio is likely to remain elevated until an economic recovery is visible for all to see, this suggests that when recovery comes, there may be an awful lot of dry powder, certainly well in excess of 100 billion pounds. Will this support a recovery in physical retailing, leisure and hospitality? Well, I'm not a behavioral scientist, but unless private debt and tax liabilities have accumulated in equal measure, which I don't think they have, these sectors should feel a substantial lift. And if the tourists return, then it may be time to party like it's 2021. Although given that unemployment is rising, partying may be premature, irrespective of the imminent unlocking of the economy in 2021. As is well recognized, the stamp duty holiday until next March has resulted in a substantial lift to the housing market and to house prices. Stoking the housing market to support the economy is, of course, a tried and proven recipe for supporting the UK economy. This occurs partly through the so-called wealth effect that improves consumer confidence, but it also has direct effect because house movers spend on average around £5,000 to furnish new houses or flats. The chart shows that all regions of the UK are feeling a lift, with house price growth exceeding inflation substantially. The government announced at its annual conference in October the idea of providing first-time buyer access to 95% loan-to-value mortgages. Boris Johnson also tells us some 2 million possible first-time buyers could benefit. Well, simple math would suggest that this could amount to another £10 billion bonanza for home furnishings and DIY operators. All right, admittedly, there may not be 2 million homes ready to buy, but perhaps there is some life in this retail party. And given the pent-up savings, another question that comes to mind is, will Christmas come early this year? Well, we'll see, but I tell you, a Brexit deal would be welcome. But I would like to think that the best gift would be an end to COVID so that we can all get back on track to visiting our families, running our businesses, creating wealth, paying taxes, in short, rediscovering our own personal freedoms. Thank you. And since Christmas trees are authorized for sale now and are considered essential goods, it seems essential to wish you all a happy and festive year-end. Duncan?
Thanks, Walter. Fascinating insights there, particularly on the level of saving. Certainly hasn't been happening in this household, but obviously is pretty widespread around the country. Now, normally when we have a midsummer retail report, we have a theme. Things have been a bit disrupted this year, but I guess in terms of today, if there were a theme, it would be around restructuring. And we're now going to show a short 5-minute film about that theme. Thank you.
The disruption caused to business by the pandemic has meant that for the first time in more than 30 years, it's not been possible to publish our annual Midsummer Retail Report. Lockdown caught everyone, not just the business world, unprepared, and we all scrambled for a response. But several months on, there's more of a pattern emerging in how landlords are responding and what that means to the market.
And certainly the consensus is that traditional leasing structures are no longer entirely fit for purpose, and a much more layered response, which takes into account additional factors, has to be applied. The pricing of space needs to reflect the value of a store to all channels, stay aligned with changes in consumer behaviour, and offer parity with online. Readjusting pricing on an annual basis rather than every 5 years will be an important first step, but getting to grips with non-till based value is equally important. We're developing a model which encompasses both, calculating a base rent priced on a range of visitor-centric metrics, including footfall, visitor behaviour, and spend. A top-up based on the number of people that pass through a store is then applied, similar to a cost-per-click approach that we see online.
After months of chaos, the UK retail leasing sector is beginning to show signs as to how it can move forward once again.
It would of course be foolish to overstate the level of leasing activity in comparison to even a year ago, but the fact is there are a group of occupiers, both new and established, who are looking at restructuring their physical store networks. Of course, they're often looking to shed space, but a growing number are also exploring where they want to establish a presence and how their store networks should look over the next few years. A good example of these two contrasting facets of the market is our work with the Carphone warehouse and also with Sky. We're advising Carphone on the disposal of its large UK store portfolio, but we're also working with Sky, who has only very recently entered the market to establish a network of high-profile new stores.
Across the retail property investment markets, a combination of continued retailer failures and the disruption of 2 lockdowns has made trading extremely difficult.
The pandemic effectively closed segments of our market, with the exception of the grocery sector, which saw substantially enhanced trading levels, and elements of retail parks, which provide environments that are more in line with a socially distanced world. This had a direct correlation on investor strategies, where we observed a marked increase in demand for supermarkets, whilst there was still interest in retail parks, especially where DIY, and in particular B&Q, are a proportion of the income. That said, like the leasing market, the picture is one of extreme asset stress combined with potential opportunity.
Even prior to lockdown, there was a relatively low level of retail property development taking place, and that has been further stifled.
Alongside our acquisition work for our active food store clients, the majority of activity that we are seeing tends to be focused on the repurposing of retail assets. We are working on a number of really exciting projects across the country that are assisting the much needed process of regenerating redundant shopping space and replacing it with a mix of viable alternative uses. From the asset management of shopping centres to leading the complete redevelopment of properties into new mixed-use schemes, we are creating solutions for clients and adding considerable value to their assets in the process.
As we approach the year end and what would normally be the high point of the retailing calendar, the dampening effect of a second lockdown has been tempered by the tantalising prospect of being able to counter the ravages of the pandemic.
In many respects, the story about this year is how retailing has managed to continue in the most difficult situations. Even with the long and growing list of retail failures, there has been a core of activity. However, even if, as everyone hopes, the pandemic can be brought under control, there's no question that our retail sector has been irrevocably changed by it. For the past couple of years, we've talked a lot about repurposing retail, but from here on, we need to continue that process on an asset-by-asset basis, but also look at a comprehensive restructuring of how we create property that best serves the retail industry.
Okay, hope you enjoyed that sort of very fast move through some of the themes that we're going to be talking about today. Hope you also enjoyed a glimpse into some of the living rooms, hallways and spare rooms of our experts. Obviously slightly more homespun film this year than our usual production values, but I think it maybe caught the spirit of the times. I'd like to bring in a couple of our guests now, Peter Harris and Simon Thomas. Peter, if I can come to you first, co-founder of Hotel Chocolat, a major online presence and also a UK store network. I mean, first of all, if we could just talk about how the year has been for the business. Oh, I think you're still on mute there, Peter.
Thank you and good afternoon. This year, I mean, we were hit quite hard because we were just coming up to our Easter period. So we'd stopped all our locations with Easter eggs. And we literally had a week's notice of having to close our 120 locations. It was pretty savage because our online business, although it's been pretty strong throughout, we started it online. It was very difficult to adapt very quickly. But what we did is we brought our Easter eggs back to our distribution centre. We then offered the National Health Service workers the same benefit as our employees, and literally that was taken up. So we morally felt great that we helped the National Health Service and the effort, and ethically we were delighted. Financially, it cost us £3 million alone on just that action. In the period to June, we lost £12 million. But coming through all this, we doubled the size of our distribution centre to 200,000 square feet. We've had in the second period up to the lockdown, we've had several months to get our act together. And obviously at the time we had to organise all the social distancing. Our factory was closed for 8 weeks. So these are pretty difficult things. And clearly we've got a very good team who've been very agile in the way they've approached it. And we've tried to mitigate it as much as we can, but there's no doubting it's been very tough and the business has suffered. But, we're a confident business and, we're very happy that, we will get through this. And, we've got lots of ideas that we're working on with various people.
And was there any compensation having a strong online presence in terms of what was the kind of balance of people who might have normally gone in store said, well, I still love Hotel Choc's products, I'm going to get them online? Did you see a bump online?
Of course we did, yeah, and it's considerable. We went up about 150%, and that's obviously great news. But any of you who've been to Hotel Chocolat locations will know that we also provide ice cream, drinks, etc. And those are things which don't obviously travel. But with Hotel Chocolat, we're passionate about our theatre, our involvement, the way we communicate with our customers, and we love them coming into our retail spaces, so we like them to understand and appreciate the ambience, the confidence of our staff who know all about chocolate and all the things that the customers want to talk about. So, online doesn't replace that special feeling that, gives you a dose of happiness when you come into one of our spaces.
Yeah, and Dan was talking in the film there about some retailers who are actually on the front foot, or restructuring their networks, looking for opportunities, maybe consolidating. Is that something that you've been doing as a group or actively looking at?
Yeah, what we've been doing is I appealed to our landlords back in March, asking them to waive rent, particularly for when we weren't open or when our business was substantially down. And obviously, I think most of you will know that London has been probably the worst location. So we've had, I mean, I would say most of our landlords have been very sensible. We've worked well with them. They've waived a lot of our rents, and that's up to 9 months in some cases. And others, we've modified the basis on which we operate into turnover type bases and including new leases.
Okay, thank you for that. If I can just turn to you, Simon, in terms of restructuring. I mean, at times of economic disruption, certainly on the scale that we've seen it this year, the normal assumption is that that people like yourselves at Moorfields Corporate Recovery get very busy very quickly. But am I right in thinking that hasn't been the case this time around?
Yeah, I think you're spot on there. What has happened is, obviously at the beginning of the process, everyone was expecting us to get very busy, and the government moved quickly to sort of bring in these sort of new measures to try and assist people. So everyone, lawyers included, got very busy helping borrowers and businesses generally, trying to explore and understand exactly what this new legislation meant that was coming in so quickly, at the same time as trying to understand how the furlough scheme worked and what they were able to do to protect their businesses. We assisted with that. But in terms of formal appointments, basically the banks were under a lot of pressure to forbear wherever possible, and they certainly have followed that advice. The revenue have come through with the time to pay agreements that they've been encouraged to offer, very generous terms. So you've got people who are able to negotiate time to pay arrangements going up to 3 years to pay arrears without any difficulty at all. So with the input of the bounce back loans coming in as well, there's cash coming in. So in many sectors, you have companies which have been struggling to survive who've actually got more cash now than they had before, which wasn't exactly what people were expecting to come through. Having got all those measures in place and seeing people being able to continue their businesses one way or another, the expectation was that there would be sort of a surge of work would come through for people who weren't able to survive when that support was withdrawn. And the expectation was that the furlough was going to stop at the beginning of December. So everyone was thinking that was going to be the end of sort of the support, and we would then get busier looking at situations which couldn't be turned around. What then happened is we got the extension now to next March. And now if you look at people in my world and we're wondering what's going to happen in terms of formal work, we're thinking that when that furlough ceases, we're going to see businesses in more difficulty. We like to think the vaccination, when that comes through and people see that that is working and there's an end in sight, that will encourage people to invest in businesses, either to restore an existing business or company to solvency, or alternatively, at this point, they're going to be prepared to put more money in and go through a restructuring. And there may be a possibility of pre-packs coming into play at that point. And if you look at the legislation sort of changes that have been put in at the beginning, there's sort of 3 real changes that come through. They've got the sort of so-called, this is under the Corporate Insolvency and Governance Act, we've got something called a moratorium, where the directors effectively are left in control and they can get this moratorium to protect them from any actions being taken by creditors, but it has to be monitored by a monitor. Monitor for people in my position is quite an exposed role to take, and not one appointment has been made on that basis yet. There's also the sort of cram down plan, which they have as well, which only 2 companies have done that. That was Virgin Atlantic and Pizza Express. That hasn't really, well, only 2, quite complicated, quite expensive. But I think the expectation is that when the sort of moratoria cease and the government aid is withdrawn, then it is possible that those procedures will become sort of more possible or more popular, because they'll enable directors to take control of their businesses under certain sort of constraints and be more debtor in possession.
If you were a betting man, what would your money be on in terms of March? Is March going to be the really the next chapter, or do you think they're going to kick the can further down the road?
April, May. Well, the other thing about kicking the can is that the revenue preference status switch is being restored, is due to come back in on the 1st of December. And we're just wondering whether or not that's really going to happen. Other things have changed very much at the last minute. And we also wonder about, at the moment, obviously, you can't take action to wind up companies or bankrupt individuals. That's due to cease at the end of December. But if the furloughs has been continued to the end of March, many pundits think that that's likely to change as well. But let's wait and see.
Okay, thank you. So turning to actually what's happening within the retail property sector. I mean, obviously it's easy to just talk about what's happened since early March, but restructuring of retail property assets was happening before that. Ever since really June 2016, I guess, when things started going pretty much sideways. David Fox, if I could just bring you in on a kind of outline of the work that you've been involved in and how that has progressed or accelerated or been made more difficult by the pandemic.
Well, thank you, Duncan, and good afternoon, everybody. I don't think the pandemic has necessarily made it any more difficult. I think it will something that we will come back to a number of times this afternoon, in that this process started some years ago. I was actually struck by one of the graphics that we just used in our film, which came from a Midsummer report in 2015. And the strapline there was, "It's retail, but just not as we know it." And in a way, the retail industry has actually been preparing for this moment and for the regeneration and restructuring since 2008 and the crash. And as I said, what we've seen is a real acceleration in the last 9 months. 5 years has been quite a long time in property, but the last 9 months seems to have flown by in terms of the activity that we've seen. And I think it's also worth bearing in mind and bringing some importance to the fact that we are coming to the end of what really is a 50-year cycle in the retail sector. It's a long time since the original bull ring opened in 1964. And for those of us that are just about old enough to remember, Brent Cross opened in the mid-1970s. And a lot of those schemes are now, and a lot of the changes that we saw in that sector, it's just a natural progression. It's not really a revolution, it's more of an evolution in our industry. And that's what we expect to see in the years to come.
Thanks, David. Turning to the leasing side, Dan, you talked briefly in the film about retailers restructuring, downsizing, others being on the front foot. I mean, I presume those who are restructuring and downsizing are still very much in the majority. But what's actually happening out there across the UK?
Yeah, well, given what you could probably kindly call the sustained incompetence of our government in constantly changing and incoherent restrictions, into tiers, out of tiers and the likes, and also what's been quite sobering has been their clear lack of understanding of the retail and leisure sectors and how they work. Taking all that into account, it would be absolutely perfectly understandable if no occupier wanted to do anything at all in the UK. But amazingly, I think our sector has once again showed its absolutely profound resilience. As David said, we've been in testing times for many years. This is a different and very big test, but a lot of the sector's proving itself to be amazingly resilient. And what that's meant is we do actually have an occupational market. It is skinnier, it's fragile, it's pretty slow moving, but it is there. But that still sounds very much like a market that we've had for the last few years anyway. So, it's still there. And we touched on the video very briefly on, you may have seen some of that slide come up with some of the logos of who's actively in the market. And there is quite a big group of occupiers who are planning for the short and medium term and see something in the UK market. I think they must have heard Walter's wall of cash analogy, and they want some of that for next year, I think. But those retailers are a real mix of homegrown UK retailers, but there are also American, French, German, Scandinavian, Irish retailers all in the market right now to take new space in the UK.
As a segment, it felt quite fashion-free. Those types of offers. Is it fair to say that the most stress is in the fashion-orientated retailing sector?
Yeah, absolutely. It's an extremely difficult market at the moment with very low margins. It's a very hard product to deliver at the moment, particularly in a socially distant world. And there are lots of other sectors that have taken precedence instead. And the key things we're seeing that occupiers need to make deals tick is flexibility, fluidity of contracts, absolutely key. Manageable costs, that's ongoing, and also a low level of investment going in. And short term with exit routes. And we've been talking, people who've attended our midsummer stuff in the last few years, we've been talking about that for quite a few years, but it's absolutely never been more relevant than now. And it all points to most retail property, if it's going to be successful long term, there's got to be an acceptance that the amount of money spent on development and on store investments got to go down. Stores are going to have to be very actively managed and run by landlords, very much in partnership with occupiers. There's no longer the money and the margin in retail to drive anything other than that in retail property. So I think we've got to bear that overall strategic element in play all the way through this now.
Well, there's certainly a theme I'd like to come back to in the discussion session slightly later on, and bring in turnover and obviously the new leasing model that Matt Thompson talked about. For the present though, we're going to go back to the coal face, as it were. We've got a even shorter film where various members of the team are going to talk about highlights from the year to date of work they've been involved in. Thank you.
Introducing new uses alongside retail is a growing trend, and a great example of this is when we advised Aldi on their acquisition of their new store in Sandhurst, and we sublet some surface space to Energy Gyms. The sublease was agreed in March 2020, and despite some slight tweaks to the terms, we progressed through legals during lockdown, and Energy have since taken occupation. To complete a new lease transaction with a gym when they were under forced closure by the government has been a real highlight for me for 2020.
The highlight this year for Colliers Belfast was working alongside our capital markets team in London on the sale of Abbey Retail Park, Newton Abbey, for £33 million, which has actually been the largest retail transaction conducted in Northern Ireland in 2020. We acted on behalf of Hammerson plc, and this Tesco anchored retail park was sold to the Canadian REIT Slate, and this was their first acquisition in the United Kingdom.
The food store investment market has remained exceptionally strong this year, in part supported by the exceptional sales growth seen during the pandemic. We've been involved in a number of high-profile transactions, but a notable deal was the acquisition of a Tesco store in Enfield on behalf of Realty Income REIT for £67 million.
I think what's really stood out for me this year has been the positive impact that strong landlord and tenant relationships, achieved through cooperation and transparency, have on negotiations. A great example of this is Connaught Village, where we've developed strong partnerships with each tenant, new and old, and this has allowed us to agree 9 new lease renewals and 3 rent reviews since the initial lockdown on the 16th of March.
We have advised both Russell and Bromley and Skye in acquiring space within the St James Quarter development in Edinburgh, which is due to open in April next year. This scheme will undoubtedly transform the retail landscape in Scotland's capital, and despite the current economic conditions, has leased well.
It was great for us to be involved in the letting, which brought Swarovski's new and visually stunning Crystal Studio concept to Oxford Street. Another highlight has been the opening of the Pantechnicon. It is one of the biggest openings in London this year, and Grosvenor have created 5 floors of Japanese and Nordic food, shopping and drink in a beautiful period building. It will be transformational to this part of Belgravia.
Excellent. Some standout deals there, and also a standout scarf from Johnny Miller. We love your style, Johnny. We finished there talking about a scheme by Grosvenor, the Pantechnicon in Belgravia. And I'd now like to bring in the two London-orientated panelists today. Joe Lee, who's head of retailing at Grosvenor, and Sam Cotton, who's head of leasing at the Battersea Power Station Development Company. Joe, if I can come to you first, really it's the same kind of question as I put to Peter. How has the year been to date, and how have you coped with it, and how are you feeling now that we're in a second lockdown, but hopefully coming out of it?
Thank you, Duncan, and good afternoon, everybody. Yes, I mean, I think, as everyone's kind of stated on the call today, 2020 has been unbelievably difficult, whichever kind of side of the fence you're on, landlord, agent, occupier, restructuring the whole piece. I think from our perspective, in terms of our headlines, really, from our response were for the sort of the first lockdown. I think we came out sort of pretty early. I think it was the day after lockdown was announced. We provided a 3-month rent-free for hundreds of our retail, leisure and hospitality occupiers, regardless of size, across the estate. And our kind of financial support continues to evolve, and we're offering very similar financial support for this kind of latest lockdown during November and December. And I think the key thing in doing that was we've recognised that we need to start to change the dialogue between landlord and tenant into much more of a kind of an open, positive conversation. In the majority of cases, it's hugely time intensive, but in the majority of cases, we now have a much better understanding of our occupiers' businesses than we did before. And consequently, and again, this kind of theme has come through some of the speakers, earlier, is that we're kind of trying to work much more in a partnership way to kind of find much better, more sustainable rental structures that benefit both sides. I think the other thing that was hugely successful from the government's perspective was the Eat Out to Help Out scheme, and we actually extended that at Grosvenor's cost for the month of September. And across the estate, that delivered roughly 50,000 people that used the scheme, an additional £1.5 million in additional turnover for the estate. And again, that was, it's just a kind of real feel-good factor for everyone in terms of sort of getting out, really, encouraging people back onto the estate, trying to encourage a level of normality that perhaps we kind of hadn't seen before. And actually, one thing that I think, the country from the very top to the very bottom, it was that real kind of sense of just wanting to have a break, wanting to kind of have a great piece, plate of pasta or whatever it might be, just kind of put in front of you and just not have to deal with the washing up that evening. And finally, one of the areas that we're sort of looking at is we've recently announced an investment fund, in recognition of the challenges that a lot of our occupiers are facing in terms of CapEx. If they've taken out Sybil's loans, the challenges that they face in terms of being able to borrow more money, or whatever that might be, and we are wanting to use that fund to help kind of strategically mitigate and fill voids across our London estate. So, on balance, there's been some real opportunity, but nevertheless, it's kind of set against a backdrop that is, very, very challenging.
Are there any? It's certainly too early to use the phrase green shoots of recovery, but is there any leasing activity beginning to come through in terms of, since the summer and before we went into this second lockdown?
Yeah, very much so. I mean, funnily enough, actually, literally in the last week, we've put 4 units under offer, and absolutely kind of, I think it was Dan alluded to earlier, they're not to fashion occupiers, they're to beauty and food. We've actually we literally exchanged last week with Barbara Sturm to take a unit on Mount Street, which is we've been courting them for a very long time, and that deal was under offer before we went into lockdown, and we've managed to kind of get that across the line. The market is thin, but I definitely think that if we as a landlord are being just unbelievably creative in how we can structure deals to to ensure that, you know, we can kind of keep that activity level up across the estate. And I think the other thing is, you know, lockdown has, I think it's given everybody a little bit more time. You know, it's given people time to just stop and think. And some of the conversations that we're having with occupiers, I think, you know, I'm definitely, you know, we're having conversations with non-traditional tech companies and how we're able to connect people together. So, you know, facilitate conversations, connect people together. And I think because everything's been shaken up so much, there is a lot more willingness to try. It feels like maybe there's less at stake than there was before, and therefore, you know, almost what have you got to lose? Then as long as, you know, it's small scale, what have you got to lose to kind of try and see what happens, which is really positive.
Interesting. Again, I'd like to come back to you about that sort of evolution of deal structuring a bit later on, but just for the moment to move from a very mature retail and hospitality environment like the Grosvenor's holdings to well, it's not a new kid on the block, Battersea Power Station in every respect, because there's been a Circus West village opened there a couple of years back, and everything is moving now towards the big opening in the big building. And I just wanted to bring in Sam Cotton. And Sam, I'm guessing this year has not looked like it was supposed to in many respects, not least because you were building up to a launch which is now changing its structure. Can you talk us through that?
Sure, thanks, Duncan. Yeah, Battersea Power Station, new kid on the block, just 30 years in the making, but we're almost there. 2020 was going to be a big year for us. We're in our penultimate year, and we're probably in the very unique position really of developing and pre-letting in this market. So we are properly at the coalface. So earlier on in the lockdown, I think we took a long look forward and thought we're going to move our dates. We were going to originally open Q4 2021 for the main power station building, but we decided we're going to move that back into spring 2022, when hopefully we're all in a much better environment, which seems to have worked very well with our occupiers. But I think just touching on the point that Joe made, we've been in a unique position because not only are we a developer, we've got several thousand construction workers we've got to look after. We're home to over 1,000 people as well in terms of people actually living here on site. And of course, we've got to look after our traders in Circus West Village, all of whom have had to go through the same challenges that everybody else has been through this year. So we've had to wear many, many hats, whether that's supporting restaurateurs, looking after residents, or making construction sites safe. So yeah, it's been a year of many challenges. We've learned a lot of lessons, but I think my biggest takeaway from 2020 so far is creativity. There's so many new concepts, so many new ideas, and there are some really talented people that have come up with some great visions for the future.
I mean, I always hesitate, to talk about benefits from the pandemic because it has been so overwhelmingly tragic. But in terms of the context of the scheme, you've got a lot of chimney pots around where you are, and there's a lot of people who would normally spend their 5 days a week in the West End or the city or whatever, and now they've been parked at home. Have you found there's been a greater interaction with those people who at one time would have just gone past and thought, well, that's a building site, and I'm not going to spend time there? Has that sort of worked in your favour in terms of familiarisation?
Yeah, absolutely. It's always been our intention to be the village. The clue's in the name, really. We wanted to create a village, and we thought it would take a couple of years for that village to mature and become a proper place. But really, the events of this year have meant it's become much more established, more popular, and certainly better known amongst local residents than perhaps we first thought. And that's been a real positive. It's been an opportunity for us to get to know our immediate residents much better. And it's also, I think, provided a place for people to enjoy by the river, in the park, out and about in the open space.
And how is your target mix changing in terms of, as you say, you've been a long time in the the making, even in recent, from Circus West Village onwards. How's that translating into what we'll most likely see come April 2022?
It's quite interesting. If you dig through the archives in this office, you'll see all of the previous plans for Battersea Power Station, whether that's Chelsea Football Club, whether that is an 8-storey shopping centre, which is an interesting one. I'm not sure anyone will be building any of those anytime soon. But I think that's the beauty of what we're doing. We're always able to tweak and evolve. And I think to Dan's point earlier as well, it's creating something that's flexible and a partner-led approach really with our occupiers. And we've certainly seen a very different group of occupiers that we're talking to and engaging with and transacting with versus what we would have been doing 2-3 years ago. But I think that's exciting, and I think it's an interesting part of the market.
And you have the Northern Line opening back end of next year, is it, the extension?
We do indeed. So that again will very much change how people are able to interact with Battersea Power Station and the surrounding area. We've got the new Zone 1 tube station, which will go live Q4 next year, and that will be an extension of the West End branch of the Northern Line. It really just cements Battersea's place as a key part of London and the city.
Brilliant, thank you. If we can just bring in Paul Suber, the head of London Retail Agency. Paul, shorn of its tourists and most of its office workers, it has been an unbelievably tough time for London, which has always pivoted on those retail spend populations. What's the feel out there in the market now?
Well, hello Duncan, hello everyone. Thank you for joining us. There's no getting over the fact it's been incredibly tough. I mean, when you have 50% of your consumer spend coming from international tourists and they're not traveling, that is a huge impact. You couple that with office workers at home, then you're solely relying on your domestic market, and if they're in lockdown, well, you can do the maths. So it has been incredibly difficult, but as we've alluded to, as Simon has mentioned, there has been considerable support, which has kept lots of businesses going, although they are seriously limping. I think what I take from what's happened, and I think a lot of our speakers have mentioned it themselves, is that there is a crop, a new grouping of occupiers, and retail in its many forms innovates, and it's showing that now. So we are seeing demand, we're seeing interest, offers, and in fact even deals through lockdown. And I'm not for 1 minute suggesting they're on the old-fashioned upward only rent reviews, fixed rental model. I'm not saying that, but there is a lot of really new and innovative brands and occupiers who are looking at the market and looking at London in particular and saying, this is a truly global city. It's one of the best in the world. It will come back. We believe in its future. And here is a once in a decade opportunity to pick a building that we've wanted, that we've coveted, and it's now available, or it's an opportunity that can be available, and it's on rebased terms that make it economically viable. And, if you're optimistic and confident, those companies are saying, well, actually, I'm going to take advantage. And if there's light at the end of the tunnel, and we think we might have, herd immunity through the vaccine by the summer of 21, as Walter has suggested, cash in the attic being ready to spend, then I'm actually very, very positive about the sort of medium term for London, and it's returning to its former glory.
But if rents are rebased at the moment and that scenario played out, would you expect them to jump up, or would this actually be a reset that we would see, back to more the traditional drift up of rents across time?
No, I think the structural change that's been happening in the market has just been hugely accelerated, and I don't think there's any going back to the old way of doing it. It's a brave new world, and the winners are going to be those people that are ready to adapt and evolve. And I think We've heard it already today about the flexibility that owners and retailers are showing. And in many days gone by, we used to talk about the landlord and tenant partnership, which never really existed. I think as a result of this crisis, I think it will going forward. There definitely will be a proper landlord and tenant partnership, and both sides, can prosper together.
Great, thank you. I'm going to ask Tom Edson to come into the conversation. I've been sitting there very, very patiently. Tom, from the investment side of things, you mentioned in the film, what's hot and what's not. I wondered if you could just put some kind of transactional volume context on the sectors you were talking about, where there has been demand.
Yeah, thank you, Duncan, and good afternoon all. I've been waiting patiently, but I think also learning, putting it down for my CPD. So there's an hour for me. Yeah, we mentioned that supermarkets and retail warehousing are kind of the two which we've seen the greatest momentum. Putting supermarkets, first of all, in context, we're obviously not at the year end yet, and Q4 is our busier season. But there's about £1.5 billion of supermarket investments have transacted this year. And to give you an idea of how that fits in the context of a general market, the 10-year average is about 1.3 billion. So we anticipate there's a fair amount of product under offer at the moment to close out in the next month or so, but it's looking likely that we're going to have another, obviously a very strong year in that supermarket world. It's probably the other kind of observation we're seeing is that if you add up the shopping centre volumes and retail warehousing volumes at the moment, it's only broadly about £100 million ahead of supermarket volumes at the moment. So really to show how that classic flight to safety, retailer stayed open, has done very well in this crisis, has understandably gone into a flight to safety from investors. The other thing I was going to say, though, which kind of slightly laughs in the face of all of this, is if you actually look at the volumes to date in those three particular areas, so excluding High Street, we're currently at just over about 3.2 billion has transacted. If you actually look back to last year, it was 3.6 billion. So it's probably not the huge change that we may have expected, but I would say you do need to take into consideration what we have seen is yields moving out. So vendors' expectations have certainly dropped. So where we've seen yields, certainly in retail warehousing, fall out a long way, we've got a new breed of investor coming in who is happy to commit to those products. So actually in volumes, they will be lower, there's no denying that, but we're still having a reasonable level of transactions.
Yeah, and crisis situations always bring the prospect of opportunistic buying, and obviously there's been pretty dramatic repricing over the last few months. But do you think that with the prospect of a vaccine and what Paul was talking about, some sort of return to normality next summer, do you think that window's closing, or yields just beginning to tighten up a bit as people can actually see their way through it, or do you think it's still very much a soft market?
Certainly short to medium term, taking supermarkets aside, it's still a soft market. We still don't know about vaccine rollout, how effective it will be. All aspects of the retail market are intertwined. You need consumer confidence, you need stores open, you need punters in the doors, you need happy retailers, you need rents to be paid. So it's all interlinked. So until we actually see the data to support the consumers out and spending, I think it will still be, we'll still see yields staying where they are. It will be interesting to see this time next year what happens, because like I say, medium term we could see an improvement, but we are always mindful that there is too much retail. So ultimately we expect the poor assets to effectively disappear, which will therefore probably help the yields for the assets which are remaining, because they're fit for purpose for the retailers.
Okay. Thank you. I'm talking about paying the rents. We've got Matthew Thompson on the call, who is the chief architect of the new leasing model that was talked about in the film, which is drawing together a lot of strands, new ways of thinking across the market. Matt, I wonder if you could just go through kind of how you're doing that building and how you're getting buy-in and the right perspectives from the right parties across the market.
Yeah, sure. I think just to start off, actually, there's absolutely no doubt that the pandemic is reframing the way that shoppers engage and use physical stores, and that's actually what has totally underpinned our ideas behind the new model. So any new leasing model, as I said in the video, has to be dynamic and it has to stay aligned with changes in consumer behavior. One thing we can be sure of is that physical pure till-based sales will continue to have the highest proportion of the total transactional value of the store. But what's really important is that we start to build a model based on all channels that drive value for a store. And that's, as I say, that's the framework for the model. Again, another idea behind it is to benchmark physical retail stores against online in a way that's never been possible before, and that's thanks to the amount of data that we have access to today. One thing I just wanted to mention briefly is it is really important to mention the validation process that we've been through so far in terms of before we've gone out to press on this. It's really important to say that this has been through had input from valuation and investment experts, and then we've had a select group of landlords and occupiers, so on both sides of the fence, to get buy-in. At the moment, we're testing it on quite small scales at the moment to support further validation, and we're hopeful for a larger rollout next year.
Okay, thanks. And you mentioned in the film that it's a model that works best with multi-units in one ownership. Paul, I mean, obviously London's an important market. Do you see it working in the more granular market of London, away from major shopping centres or as their multi-unit shopping environments?
No, I think it is actually aligned for shopping centres or estates or dominant ownership of single streets. I don't see it necessarily working for a standalone retail asset on a major thoroughfare, personally. And I think what it does do, this model, is it really does align in the interest of the landlord and the occupier. So they're paying a base rent based on the number of people that inherently walk past the store and then how many people cross the threshold. So that really de-risks it from the occupier's point of view, and it's not over a 5-year pattern. It can be adjusted annually, so it flexes depending on the performance of a particular location, and I think that makes a big difference. But no, I don't see it working on a single asset.
Okay. And Dan, I mean, if this is, looking at retail leasing 2.0 somewhere, down the road a bit, I mean, turnover, application of turnover, there's been a lot of talk about that. Is it actually happening in the market now as landlords and occupiers hash it out and find a new basis of going forward?
Yes, I think, listening to Matt talk there, it's a really fascinating insight into where we might be going next. That's already looking well beyond where we are today. And I think where we are today, particularly given, we're 6-7 months into this big change. And I think when we did our midsummer in June, we were quite surprised about how much PR turnover leasing was getting, because for most of us on that call, we were already deep into that market already, and turnover leasing had been very prevalent for the last 4 or 5 years. And I think the press got hold of it early pandemic and thought it was a very novel new thing, and it's not a novel new thing. It's definitely had a real push from the last few months, to make it more prevalent, but it's a pretty established pattern, and I think we're going to see much more of it in the right environments. And I think Paul's point is really important, that it's got to be in the right environments. A turnover-based model doesn't have to be scary. That's one of the key things that we always hold dear. You ideally need well-informed, engaged and open-minded landlord, occupier and agent involved in the process. Ideally all 3. 2 out of 3 is good enough, but 3 out of 3 would be great. And the key tests for us are always, you've got to have complete transparency going into it from both sides. You've got to come up with an equitable solution from it for both sides with a complete share of risk and reward. And then probably the really key test is, it's not going to be universal. It's not going to work in all scenarios, and it's not going to suit lots of tenants, and it's not going to suit lots of landlords. And I think we just need to bear in mind it's an essential part of our toolkit for deal doing in future. It's not the only tool in that kit. But really interestingly, I think where Matt's taking us with his thinking of his model is where we will end up over the next few years. The blunt tool of just turnover only linked to till sales will not be sophisticated enough and will not reflect enough. And I think it's really interesting. I think watch this space with Matt's work. I think that's where we're all heading for the next few years.
And I have to ask Peter Harris his views on this topic as a major occupier. Peter, what's your feelings about both turnover leases and a future which is where leases are based on more metrics than we've previously seen in the mix?
I think it's just going back to something that Paul said. The idea of landlord and tenant, the words are terrible. They're sort of like master and slave, and in a politically correct world, they should be, removed. I think partnership is really important. I think to Hotel Chocolat, the most important thing is, if we can sell chocolates in appropriate volumes, we're happy to pay rents, fair rents. And I think it's about agility for us. So in other words, we don't want to be locked into something that if in 3 years' time we need stores that are twice the size, we don't want to be caught in a situation that's inappropriate. So I'm seeing shorter leases, and whether that's for the long term, I don't know, but certainly we're signing up to 1, 2, 3 year leases, definitely turnover only. I'm actually a fan of a couple of things. One is I don't mind paying advances rather than minimum guarantees. I mean, one of our top landlords is Network Rail, and the first thing they did when we had the lockdown was they removed the minimum guarantee rent, and immediately it emphasized the whole problem about having to pay a big rent in an area, particularly London, where we weren't doing any business. So I think an advance is not too bad, so that if then sales go down, then the tenant isn't in a position whereby they're caught. And I think people shouldn't, I'm talking landlords, shouldn't be afraid of turnover rents. I agree entirely with Dan. And if you're a successful location and we're a successful retailer, you will get your rents, and you'll probably be surprised that they're pretty good rents. I think just some of the other points really. I think when you've got different models, I don't think you're going to find a universal model. What we're paying for our rent is not necessarily related to the person next door, and you've seen that with CVAs where people have signed up to very large rents, and then they go into a CVA a couple of years later. And yet, when we're in a rent review, I think the other thing is just quickly is rent reviews upward only are removed if you get a turnover situation. But the other thing I'd say is rolling breaks are actually a very good idea. And I think landlords shouldn't worry about them, because one of the things they do is they mean that you don't have to make a decision at a certain time. So in other words, when there's a break, you have to make a decision, are we going to break or not? Whereas with a rolling break, you can have a conversation and say, look, this isn't working. And if we can't resolve this, then we're going to have to leave. Whereas, there's no pressure, so it can drift on. And in fact, from a landlord's perspective, ironically, that might be a better approach.
Interesting. Joe and Sam, if I can just get a quick view from you, because Joe, obviously you're dealing with a lot of existing occupiers, and Sam, you're in a lot of leasing conversations, new lease conversations. How is this influencing your models, your offer to occupiers? Jo, sorry, can I bring you in first?
Yeah, of course. So, you know, I think, you know, they're very much kind of prevalent within the hospitality industry, and we've, you know, I think across the West End, you know, they've very much been there and here to stay. I think retail, it's sort of, we've been doing them for a while, but yeah, totally agree with everything that kind of everyone said in terms of in terms of they're here to stay, and there's going to be more of them. I think, you know, probably one of the challenges from a landlord side is really in terms of how the valuers wrap their heads around them. And that's the piece that, you know, we constantly kind of have to balance. And, you know, the sort of the reality that, you know, about zoning and, you know, what is that anymore? I think we've all probably decided that that's, you know, definitely something from the kind of the dark ages. But I think that valuation pickle needs to be, you know, that is definitely going to need some thought over the next 12 months, because that's going to be important from certainly from a landlord side.
Sam?
Yeah, completely agree. We've done probably just shy of 100,000 square foot of deals, lettings this year in terms of, you know, new deals or recently instructed, and I don't think two of them are the same. And I think that's where we are. It's flexibility, and it's making sure that what we do is appropriate for the business that we're partnering with. And I think from the outset, we've recognized that, you know, one size fits all doesn't work. So I think that is the most sustainable leasing model that we can adopt, and that's what we've been trying to do.
Okay, well, just a quick douse of cold water before we look ahead to next year. Peter mentioned CVAs, and it would be remiss not to touch on them quickly. Simon and David Fox, if I can bring you in on this, just really about their continued use and possibly abuse. I mean, is the situation settling down now, and are landlords just getting sort of wearily resigned to their use, and it's more of a conversation than a battle, or is it still a very contentious area of the sector? Simon, do you want to come in first?
I think for the landlords, it certainly is contentious because they feel they have these things forced on them and there's nothing that they can do. I think probably the Clarks one is quite a good example of that, where I think you have to get a 75% majority to get your requisite majority through to make the CVA work. And in that one, the landlords only represented 20% of the creditors. So they were going to get caught on that. Personally, I've always think CVAs are rather generous for the shareholders, because frequently the creditors are asked to take pain, and if the plan actually works, the shareholders end up with their equity recovering value. But again, on that, Clark's one is quite good in so much as they've 100 million investment coming in from a PE house, which hopefully gives the remaining landlords some comfort that some investment has gone in, and it means that the shareholders aren't getting away scot-free, which is typically the case. In terms of numbers, I think that the amount of CVAs in the food and retail sector in Q3 of this year was equal to the whole of 2019. So I think there still is a volume there to go through. When you look at all the changes in insolvency legislation, which I can't imagine you bother to read, but CVAs don't really feature in that. So it doesn't look as if there is a government appetite at the moment. So I could be wrong on that, but nothing I've seen whereby they're looking to try and change it. So I think that, you know, in last year we had the Debenhams challenge, which was defeated when Ashley was funding 5 landlords to go after Debenhams and that to attack the CVA, and that didn't work either. So I think whilst a lot of people think it's unjust, I don't think it's going to change in the near future.
Thank you, David.
No, I think Simon's right. Sadly, it's not going to go away. It's become a business tool that's used by many businesses. Unfortunately, landlords do feel like they're the ones that, frankly, pay for it all at the end of the day. And I think also fairly fundamentally what we have seen during lockdown is people taking advantage and, dare I say it, use a form of CVA creep, where what they would not have got away with 2 years ago is certainly getting voted through now, because it's about their very existence. So as Simon says, it's probably been postponed for first quarter or second quarter next year. Unless it is addressed, we will see some more, and undoubtedly it will be landlords that bear the brunt of the pain.
Thank you. Okay, I'm conscious of time, so I'm just going to finally come to our guests for a bit of a, well, it's not what I want for Christmas, but maybe a look into next year and how they feel it might pan out, and hopefully if we can take some positivity out of that, it would be great, because I think we're all very aware of what the stresses are on the sector. So if I could come first to Peter, what's your feeling about 2021, and what would you like to see?
Well, just first of all, any of you who haven't been either into one of our locations or onto our website, the Velvetizer is a brilliant Christmas present. So just please have a look at that. But no, seriously, but that is serious. But seriously, we're very optimistic. We're actually expanding in Japan at the moment. So we're actually opening stores in Japan, even though there's coronavirus and pandemic. We're now up to about 12 stores in Japan, and the most recent 3 or 4 have opened in the last month. And it's interesting because landlords in Japan work very closely, turnover deals. They don't, and when the stores are closed, they don't like to take rent. It's almost a sort of honor thing. So I think there's a little bit of a lesson to learn there. But we're very optimistic. I mean, I think everyone has got to adapt. And I'm talking about retailers have to adapt, that there is a model which is online, it's and retail and retail theatre. And I think from our point of view, we will be opening stores in the coming year. And, you know, I must admit, I'm very optimistic, and our innovation is ongoing. And so nothing's really changed. This is an irritating period for all of us, but those people that work hard to develop their models and take into consideration the things that have happened. And, you know, social distancing is one of those things. In other words, if you look at us, we've been forced into slightly smaller spaces. Now we want bigger spaces because, you know, we want to be able to have more tables and chairs in our cafes. So I think that, you know, I'm optimistic, and I think, you know, next year, I don't think it'll be off to a rocket start, but I think from about April onwards, I think it'll start to gather pace, particularly if we can see some tourists back and people actually confident to go to their offices in London and the cities. So no, I'm upbeat about it.
Right. Thank you, Joe. That sounds like your cue. Planes arriving at Heathrow full of rich tourists. And,
yes, please. I think probably sort of a bit of a tale of two halves, maybe with a note of caution for me. So, you know, as Simon alluded to earlier, you know, probably a little bit concerned about what happens when we come out of furlough, and kind of more stress is seen kind of within the industry, and whether that then, you know, leads to sort of slightly wider vacancy in terms of occupiers kind of London-wide. I think, but equally, you know, I think consumers are desperate to, you know, as soon as possible sort of get out and about, you know, as they kind of, as we sort of saw before, and the quicker we can, you know, get those tourists back and workers sort of back into the West End, you know, obviously that's all the better. I think, you know, one thing I'm definitely mindful of is not being too quick to jump on trends. I think, you know, trying to work out what's long-term and short-term, you know, we've definitely fared better in Belgravia than Mayfair, due to it kind of being much more of a sort of residential neighbourhood location. Someone actually said to me recently, working from home, it's no longer working from home, it's called never leaving the office. And kind of as much as, you know, I think we all have definitely enjoyed the freedom that working from home brings, I think, you know, you can't get away from the fact that we're all, you know, people make places, and therefore, you know, actually that kind of rebalancing back into the city. So, you know, neighbourhood local towns have done better over the last sort of, you know, definitely the last 6 months. That said, you know, in the next 5 years, will that kind of demand at that level still be there? You know, I don't know, but I think it's just a note of caution in terms of that, you know, that trend piece.
Yeah, and Sam, you're in the process of making a place. I guess if people maybe are spending a couple of days a week working from home as the residual habit goes forward, that's a positive for you, I guess.
Yeah, it is. It is a positive for us, and I think it probably is something that's here to stay, certainly in the short to medium term. But 2021 and looking forward, I'm really looking forward to it. Actually, I think there are some exciting ideas coming forward. On a personal and Battersea level, it's another big year for us. Our first residents will be actually moving into the power station, which is a huge moment for the project after all these years. And we'll be getting ready for the grand unveil in spring 22. So for us, an exciting year, and I'm looking forward to it.
Smashing. Simon, I'll give the last word to you. And unfortunately, I suppose good news for you may not be good news for everybody else in terms of you being busy, but oh, I think you're muted.
Can you hear me now?
Yeah.
Yeah, I think the government have extended all this assistance to keep companies going, but a lot of them, if you want to call them zombie companies, hasn't been the most productive use of money. And I hope that when that stops, then we get into a situation where there are investors out there who've now got confidence to take on some of these businesses, be it the businesses or the companies, and invest. And perhaps we can get more productivity out of everyone and see a new future and just move things forward. And hopefully we're not carrying too much debt to burden our children forevermore. But we'll see.
Oh, they can cope with it. Don't worry. The shoulders are broad. Look, I'll wrap it up there because we've gone a bit over time, but I hope you'll forgive us because I think the content was fascinating. We'll be sending everybody a digital report which will contain a recording of this webinar, the films, and a lot more besides. So looking forward to sending that through to you. Many thanks to all of you for attending the webinar today, and I'd like to say particular thanks to our guest panelists today who have been uniformly excellent, and let's hope we get some great shopping levels before Christmas and we can all spend the festive season reflecting on a better and brighter 2021. Thank you. Good afternoon.
Thank you.